And good morning, everybody. Welcome to today's live stream. This is Andrew Wilkinson from Interactive Brokers, where I'm the Director of Trading Education. Joining me from Stamford, Connecticut, Jose Torres, Senior Economist for the Interactive Brokers Group. How are you, Jose? Good morning.
Hi, Andrew. Doing well. It's been an early day. Been talking to the media since 5 in the morning, so definitely been up quite a bit. Here we are today now. I'm going to talk about the Consumer Price Index, which we're waiting for in around 14 minutes. 3.7% is a median estimate. Markets are already a little volatile heading into the print. We have the S&P down around 40 basis points, 0.4%. President Trump is essentially there's rising tensions between the Trump team and Iran in terms of getting the war and ending the war and the different topics that the president wants addressed, and he called the recent proposal unacceptable. So that's sending oil north of $100. Interest rates are higher, stocks are lower. Also in South Korea, you had some news about that was a little bearish for the AI names from the political front proposing a tax on artificial intelligence. That served to weaken enthusiasm around the space modestly in the US, more heavily in South Korea. Also, we have the Trump-Xi meeting coming up. That's also a big development from a geopolitical stance. Geopolitical angle rather, because you have a lot of topics that the US and China aren't necessarily agreeing on right now. You have Iran, which is a sticking point. You have Taiwan, you have tariffs, AI, rare earths, Russia. So a long list of things. President Trump is going to travel to China with a lot of the tech CEOs to see what kind of agreement or what kind of deal he can work out with the Chinese. Nothing formal is expected, but we'll have to wait and see. And then finally, we have Kevin Warsh being confirmed to head the U.S. Federal Reserve this week. That'll likely culminate tomorrow. So a lot of stuff happening, Andrew.
What else do you want to talk about?
Well, first we're here due to IBKR prediction market. So we're going to play a quick video from our chief strategist, Steve Sosnick, and Andrew Wilkinson, Director of Trading Education.
What exactly are prediction markets?
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. For example, we all know that elections have ramifications for markets. With midterm elections approaching, it will be very easy for investors to decide who they think has the better chance of taking the lead in the House of Representatives, the Senate, or in any range of specific congressional or gubernatorial elections. Prediction markets make that very simple. You can speculate on these races, or you can effectively use them as a hedge on your investment positions, but doing so in a much more targeted way than one was able to do before the advent of these products. This, to me, is the beauty of prediction markets. You can express a view on something that is market related or investment related, but that has always been historically difficult to factor into prices in a direct manner.
Walk us through the mechanics. How does one trade?
In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. And you also exit your contract by buying the opposite contract. So if you're long a yes, you buy a no. If you're long a no, you buy a yes.
Then how does one calculate profit and loss?
Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because dollar value is low. And in terms of their percentage return, that's based on what you paid and the difference. So the leverage can be quite powerful. Because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return.
And what are some risk considerations?
One thing that we believe mitigates the risk is that these are financial contracts, not bets. These are financial contracts by a reputable financial firm with important financial regulation behind them. We believe that these prediction markets are a valuable tool for investors to speculate on or hedge risks that otherwise have not been easy to incorporate in one's portfolio. And that's why we feel very strongly about these products as investment tools and risk management tools rather than just purely speculative instruments.
Jose, there's no getting away from the reality of the war and its impact on crude oil supply, therefore prices, and knock-on prices for everything else in that supply chain, including fertilizer, and that manifests itself in higher costs for farmers and food and all the rest of it. What are we looking at today? How much of the full impact, the maximum impact, do you think we might be looking at for the April release?
Well, I think that there's a chance that it comes in above expectations. Maybe, our forecast trader here, the 3.7 is going at the moment for 35 cents. So you could have a 3.8% number. The 3.8 is going for 11 cents, which means that you have a much smaller likelihood of getting to 3.9%. But that's really what's been driving the most inflationary pressure, just because crude oil is such an important ingredient into so many different facets of the economy. So, for example, airfares, transportation services, manufacturing, physical goods, all those things require fuel as an input, so that when they get moved around, transported. But there are other areas that are also quite inflationary. So we do have tariffs are still much more modest, but still contribute to higher inflation. You have strong consumer spending, of course. That's really lifting a lot of demand in services and discretionary areas. And then to the downside, a disinflationary force has been the immigration restriction that we've had, and that's really weighed on rents via more housing supply, more units available on balance, but then also elevated mortgage rates have really weakened the performance of the housing market from a pricing perspective, valuation and rents. And together, that's made it where, shelter isn't expanding that fast. So that's really been a good story for inflation, Andrew, because in shelter housing, that category comprises north of 40%, that combined category. That includes hotels as well, and also includes owner's equivalent rent, which is sort of like a valuation metric over time. So those that's really the aspects of inflation right now that are top of mind.
How do you think the administration views this?
I think the administration views this as a one-time price shock. I think that right now the White House is focused on its military goals in the Middle East and is fine taking a little bit of an economic hit in the short run via higher oil prices to fulfill that military goal in the Middle East and to have a more assuming foreign policy. I think they're willing to look past a lot of the short-term headwinds and really been pointing a lot to the capital markets as a source of buoyancy. And of course, there's no doubt that it has been robust. Yesterday, we had 5 consecutive days of fresh all-time highs for the NASDAQ 100 and the S&P 500. The Dow Jones Industrial Average has yet to make a high in quite some time. However, that's a more cyclical index, so that's been rare, and that really signals that the advance has been narrow. It hasn't been broad, because a lot of areas in the market are still struggling. It's really been the semiconductors, the AI stocks, names associated with the Magnificent Seven and the build out of data centers, memory chips stocks like Micron, SanDisk. Those stocks have really done excellently from a capital appreciation perspective. And what's really shocking is that you had an economic situation that was worsening from January through March, because you had higher oil prices, higher interest rates, and you had a consumer that was a little weaker. But during that time, Andrew, we actually had earnings expectations for the S&P 500 really accelerate fast. So that was a really difficult combination for investors to digest, right? And that's part of the reason why you had such a fast move from 63.17 on the S&P on March 30th to yesterday, May 11th, 74.25-ish. So we're talking about north of a we're talking about north of an 1,100 point leap in a matter of 40 calendar days or so, 42 calendar days. So, I think that was a significant bifurcation in expectations for economic performance and projections for S&P 500 corporate earnings. And one thing I think that could be misleading investors is that prior to the war, I think firms really wanted to get their hands on as much supply as possible, memory chips, computing chips, all kinds of semiconductor technologies, so that if the war caused any supply chain hiccups or any concerns about being able to acquire the right tools, that stockpiles were full enough that the firms wouldn't have to worry. Those are comments that were also supported by the ISM manufacturing survey, when a lot of factories and a lot of goods producers raised their inventory significantly once they saw that there was going to be some trouble in the Middle East.
And just a reminder to the audience, you can send in your questions using the chat panel, and Jose and I will get to those throughout. We've got about a minute and a half to the number now. Remember, we're looking for about 3.7% year over year on the headlines consumer price index, and stripping out those volatile items of food and energy. The ex-food and energy index is due to rise by 2.7% year over year. Jose, let's talk a little bit about the Fed, and I think just rip to the numbers when you see them and try and digest them a little bit, and we'll talk about them afterwards. LinkedIn, YouTube, and
Twitter X.
And Twitter X, yeah, please direct your questions to Interactive Brokers on those three channels. Kevin Morse, you mentioned, is likely to get confirmed this week, but he's going to take his seat at the late February meeting. Not really pushing for a rate cut under these conditions, is he?
We'll have to wait and see. I don't think so. It's going to be tough. Already you had some dissenters at the prior Fed meeting, Kashkari, Logan, and Hammock, say that they weren't happy with the inflation figures and the fact that they haven't been at target for so long.
All right, numbers should be out.
3.8%, so hotter than expected, above the 3.7%. Month over month, 0.6%, exactly as expected. The month over month slowed down from 0.9. The year over year accelerated from 3.3. In core, this is a negative development. Core came in above expectations as well, 0.4% versus 0.3. And the year over year came in at 2.8 versus 2.7. So that's higher than the previous months, April's March is 0.2% monthly and 2.6. So before I go into it, it looks like the higher oil prices are starting to now broaden out into other economic areas, just given that strong core number. But I'm going to dive deep in here and see what's going on.
Energies ex commodities was up 17.9%. Sorry, almost 30%, as was fuel oil, and energy services particularly strong.
Yeah, we got that lift in food that we didn't get in March. We expected that due to the fertilizer supply concerns. Food at homes. This is food you buy at the supermarket, up 0.7% month over month. Food away from home up 0.2 month over month. Gasoline now 5.4% month over month after the previous month was 21.2. So slowing down, that's good news, but the annual number is still huge at 28.4% year over year.
What does the Federal Reserve do with a report like this, Jose?
I mean, no one wants to hear it, but they have to wait to see how long the Middle Eastern conflict lasts. But if it continues to sustain higher oil prices, Andrew, and it starts to broaden out to the overall economy, then the medicine there is to hike. No one wants to hear that right now. The Fed funds curve, we'll check it out to see what it looks like. But that's really, with inflation here at 3.8 and rising, Andrew, and rising, because in May you've had high oil prices the whole month. So it may already, if we're going to look at our forecast trader later, but it's probably going to be looking at 4.2, 4.3. Another thing, new announcement, our forecast, we're rebranding our IBKR ForecastTrader. We have rebranded it to the IBKR prediction markets because we do, on top of ForecastX, which is an Interactive Brokers subsidiary, we are displaying probabilities from alternative venues. In this case, we're providing probabilities from Kalshi as well as from the CME's event contracts. So that's an interesting development. It's going to help investors potentially engage in arbitrage operations when, for example, if a contract at Kalshi or at ForecastX has a mispricing, and it's going to offer more opportunities, we think, for prediction market participants.
All right, so let's see. Is there any commentary from the Bureau of Labor Statistics that's
Shelter was up 0.6. This had to do with the October edit that they made. They essentially assumed no change in housing costs in the month of October. If you recall, folks, that was the month where the CPI went unreported due to the government shutdown. So shelter here really showing a significant increase, 0.6. That's what drove the beat on core. New cars and used cars behaving really well. New cars down 0.2, used down 0.0, unchanged rather. Apparel 0.6, that is a tariff sensitive area. Medical care services unchanged. Medical care commodities down 0.4. Transportation services up 0.3. Markets are. Let's take a look. Let's share my screen here.
Any kind of relief there for the markets this morning? I can't help but think that the backdrop of like Trump's tweet at the weekend, his dissatisfaction with the Iranian response is going to weigh more heavily than this. But a bit of respite, is that right?
Oh yeah, definitely. We got down here to around 71.73 on the US 500. We're up to 73.83. So down around 35 bips or so. Still close to yesterday's all-time high, folks, which was up here at 74.28 area. I said 74.25 earlier, so please excuse me there. But yeah, still very close to all-time highs. It's unbelievable, Andrew. We're seeing on Wall Street that essentially, and of course, buying the dip has been a significant motivator for equity market participants over the years, because essentially it's worked every time, amongst the major indices. But lately, Andrew, we've really been seeing that at every point that the market has a little bit of a decline, you have buyers there ready to assume shares, to pick up baskets, S&P 500, NASDAQ 100, especially Magnificent 7, AI related, but just the S&P 500 showing unbelievable resilience this year, folks. After 3 years of returns near 20%, S&P already up roughly 8% this year, only mid-May. So could be in for a volatile stretch considering all the things that we spoke about. But looking at the tape day in, day out, the sentiment is really, without looking at fancy indicators, just looking at what's happening throughout the trading day. And it's really remarkable to see the interest and the demand for U.S. stocks day in, day out, Andrew.
Yeah, it's extending around the world as well. I mean, the Japanese and the Korean markets have been on fire as well. Jose, you gave us a couple of forecast prices beforehand. I think you said that the 3.7%, which was the expected number today, the yes contract there was trading at 38 cents on the dollar. So that would have been the at the money strike there, as it were. Would have paid out zero, but I think you said 11 cents for the 3.8%. So that 11 cents would have turned into $1. Is that right?
No. Because it was for the yes at 3.8, you needed a 3.9 for that one to become $1. But the one below would be the case where you would, which is still a great return. Right. 35 cents would turn into $1. 35
cents into $1 if by selecting the market's prediction today. So that's an interesting trade.
And Andrew, I want to point you to what's going on for the next month's contract, which is the May release, which is going to be out in June. And you can see how high we are. 51% of 4.1. That's quite high. Above, essentially expecting a 4 handle. So
yeah,
this is really the risk here that if the Fed doesn't do something soon and oil prices stay high, of course, everyone's just assuming that the Middle Eastern conflict is going to be all right, and we're gonna pass this, and everything's going to be fine, and then oil prices are going to fall fast, and inflation is going to be back into normal. And that really is a story for next year about inflation falling back to normal, because now that you have oil prices so high now, it's going to be pretty easy to get inflation low next year because you have this high base comparison in 2026. So really, if you want to look forward to rate cuts, that's a 2027 story. For now, it's whether the Fed is willing to swallow higher inflation that's going to broaden out to other areas of the economy if this doesn't end soon, and the risk that means for markets and for the economy moving forward to sustain this period, like a lot of the dissenters were mentioning, this period where we're going on over 5 years, Andrew, and the Fed's not at its inflation target. So just staying steady here with this kind of price pressure. Let's assume that we're in the fall and oil's still above 100 and the CPI is 4.5, 4.7, very well could be. By the way, tomorrow's PPI, which tends to lead the CPI, is expected at 4.9%. So if you allow these things to continue and you're staying steady at the Fed, what's essentially happening is that you're letting the economy run extremely hot. And then the risks of longer term price pressures, weakening affordability, capital misallocation, those issues start to come up.
Well, So you say that if you allow the economy to run hot, there must be a point when the economy is actually turning down. Is that not the case with high inflation, or rather with higher oil prices and the risks too?
Yeah, the thing is that you have the other area. The thing is with the economy at this point is that if the central bank doesn't constrain activity that's running hot, considering the elevated inflation, then you're not putting any pressure on labor markets. So it's really, you need that cool off catalyst to come from a different source, not from the Fed and higher interest rates or tighter monetary policy. You would need for you to get a cool down, you would need the slowdown to come from another source, because traditionally when the economy is running hot, it's the Fed that starts to slow things down by hiking rates. So, we'll see what happens here. As far as consumers, the stock market is doing great, and if inflation is running hot and the Fed's not doing anything about it, then nominal earnings are going to do well in an elevated nominal GDP environment, right? Because if inflation is at like we saw today, 3.8%, and then real earnings growth is 3% or 4%, then you're at 6.8 or 7.8%. So how could stock markets not go up if earnings are growing 8% per year, right? So that's going to continue to support consumer spending. And then eventually the higher inflation will trigger wage price hikes, and that'll also help the consumer move forward. So letting the economy run hot, it's not a bad thing for the cycle. It's a negative thing for price pressures and for affordability.
What was the impact of today's CPI report on the bond market, Jose?
Yeah, so pretty muted here. Here we have the 10-year. Came down, was at 445, now at 442 after the report. So pretty encouraging development on the 10-year. I don't know why yield slipped after the report, considering that it came in above expectations, but nonetheless they did. 2-year yield, similar story, was getting close to 4%, and then slid back down to 396, 397. Another key thing is that if this goes past 4%, you're really in dangerous territory from a monetary policy tightening situation. And Andrew, that's the stock market can't take that.
Right.
The stock market cannot handle that. They cannot handle a Fed that's going to start hiking, because that's not, no one's expecting that. So this 4% area here on the 2-year keeps getting defended. Let's see how it looks on the CME FedWatch tool. So expecting a pause in June, July, September now, 9.2% chance of a hike, 4% chance of a cut. So standing now from where we are, Andrew, we have a much higher chance of a hike than a cut in September, albeit the expectation is for a steady Fed. But if you were to move, your chance of a higher rate is more than double your odds of a lower rate. Moving into October, that separation widens further. Chance of a hike, 20%. Chance of a cut, 3.5. Also, there's an opening here for 2 hikes by October. So this would imply a hike in September and October, but those odds are very low at 1%. But that's how it starts. If the 2-year starts running out of control and people start worrying about inflation, then you can see this 19 go up to 40, and you can see the second one maybe go up to 10 or something like that. And then finally, we'll end it. Well, no, we'll do December, then we'll do year end next year. But by December, there's even a little bit of a chance of a third hike. Of course, 0.2, we won't focus too much on that. But the point is here that by December, if you're not steady, you're probably higher, you're not lower. Going into 2027, the year-end 27 rate is also, it skews higher because we are here right now at 350, 375. But if you were to get a cut in 2027, right now, the cut would be here, 325, 350. You just really, you don't really see it, so the market has priced out cuts, folks. Here by September of next year, 2027, you have around a 27% chance of a cut down lower than where we are now. So, but through the next, call it 15, 16 months, next 5 quarters, the market is essentially priced out a cut.
Wow. Very interesting if you are an interest rate trader or you want to take a view on what the Federal Reserve is going to do. So probably some interesting plays there if you map out what you think is going to happen, and you could certainly play the interest rate markets that way. Jose, there are no questions from the audience at this point. Before we wrap it up, what's the next major piece of data that you're looking at, or what about the labor market? We just had the non-farm payroll on Friday. It's about 3 weeks before we get the new one. How's the initial claims granular data looking?
Initial claims is looking great. This morning we got the ADP weekly number, 33,000. That implies a monthly rate around 130,000. That was down from 39.25 the previous week. So labor market looking good from an ADP perspective. Tomorrow, really looking forward to the PPI. That's expected 4.9% annualized, 0.5% month over month. That'll give us some information on look-aheads on airfares, as well as portfolio management costs, as well as other critical inputs that go directly into the PCE inflation report, which we'll be here discussing in Spanish with Judy Casasampere on May 28th. And then we also have retail sales on Thursday. We're looking for a 0.9%, 0.5% month over month number. And then on initial claims, looking for a really low number, 205. Continuing claims also been very low. These numbers have been, breaking records. The continuing claims been breaking 2-year records and 1.5-year records. And initial claims, Andrew, broke a 57-year record a few weeks ago when it came in below 190,000. And then on Friday, we'll be looking at industrial production to see what the manufacturing output is of the nation, how the AI developments are working their way through a different set of data points, right? We know that we're seeing them heavy in the durable goods. We're seeing them heavy impact also in the ISM manufacturings, in the GDP report, in the business investment section, but really looking to different reports to hear about what the word is on artificial intelligence and its prospects to continue to power corporate earnings and the economy forward. That being said, we are also starting to depend as an economy more and more on AI. The consumer was a lot weaker in the first quarter GDP print. So we could be at a point in the cycle we're depending more on AI than the consumer, which it's a worrisome development if in the future the profitability dynamics or the cash flows of these projects don't deliver. But so that's a risk going forward. Same way it's a risk for the market, that it's very narrow depending on the Mag 7 and the semiconductors. Also now the economy is starting to really become levered to artificial intelligence as the consumer steps back with affordability pressures really hurting the pocketbook.
All right. A comment from Cynthia. How can we reach myself or Jose? Just send me an email at webinars@interactivebrokers.com, and I'll make sure that Jose receives that comment from you. All right, Jose. Anything else you want to cover before we leave?
No, I think we're all set. I think we're all set for now. Thanks so much for joining us. Thanks Andrew for hosting.